Okay, let's continue on with chapter 11. Chapter 20. Number 11 is where we'll start. Break-even sales and sales to realize a certain operating income. For the current year, Costgrove expects fixed costs to be $27.6 million and a unit variable cost of $805. The unit selling price is $1,150. So it says compute the break-even in sales. So again, the formula is fixed cost divided by unit contribution margin, and they told us it was 27.6. Sales minus variable costs is our unit contribution. It tells us it would be 80,000 units to break even. Compute the sales in order to realize 5.175 million. So all you do then is you take your fixed costs, add to it the desired operating income, once again divided by the unit contribution margin. It tells us now we have to sell 95,000 units. Number 13. Currently the unit selling price of a product is $75.20. The unit variable cost is $4,400. Total fixed costs are $23.4 million. A proposal is being evaluated to increase the unit selling price to $8,000. Compute the current. All right, fixed cost $23.4 million. $75.20 is the current selling price. Variable cost is $4,400. That's 7,500 units. Well, of course, if our selling price is going to go up, everything else being the same, it says compute the anticipated break-even sales in units, assuming that the unit selling price is increased. All right, well, now, again, same fixed costs. Now, that's the only thing that we increase. Variable costs are still the same. No surprise, we can sell 1,000 less units. 1,000 less units and break even. Next one is number 19. Number 19. It says name the following chart and identify the items represented in letters A through F. So letter A right there is the break-even point. Letter B, the orange shaded area, is the area below the break-even point where we will lose. As compared to letter E, the green shaded, that's where we will have profit. Okay, so letter B, we answered letter C. That's where fixed costs. That's the fixed cost line. And letter D, letter D is the fixed cost line. Letter C is right at fixed costs. And then letter F, that is the sales line. So as we increase sales, you see it in letter F. Problem 1A. It says here to classify costs. So all you're doing here is going through A through T, and you're going to label them either as fixed, just like we did in a previous exercise, variable, or it's mixed. Very straightforward. Problem 2A. Excuse me. Problem 2A is a great problem. It's break-even sales underneath present and proposed conditions. Again, there's nothing new in problem 2A. And there's steps 1 through 8. Number 1, determine the total variable cost and total fixed costs for the year. And if you look above, you can see what are the variable costs. Well, in that small income statement or operating income details, cost of goods sold, of course, is an item on there. And then there's selling and there's administrative. But if you look below that little operating income line, they tell you how much of those costs of cost of goods sold are variable costs and how much of them are fixed costs. So using those percentages provided, you can calculate what is the total variable and what are the fixed costs. Number 2, determine the unit variable cost and the unit contribution margin. So we know what the total sales are. Total sales is 188 million. 188 million in total sales, and that's right from that income statement there. Variable cost here is the 88 million. So then we get our contribution margin of 100 million. So again, they're selling 1 million units. It's provided to us in the reading. That's a contribution margin of 100. Break even in sales, fixed costs, we have that here, right? 40 million divided by the unit contribution margin gives us our break even in sales, 400,000 units. Number 4, under the proposed program. So then our fixed costs are going to increase by 5 million, it says in the reading. So now, of course, we have a higher hurdle. Number 5, it says, what about if we want to earn 60 million? So now we add that to our fixed costs, still same contribution margin. We need to sell 1,050,000 units in order to realize 60 million. Number 6, basically determine the maximum operating income possible with this expanded plant. Okay, so they told us that the sales would be increased by 11,280,000 in addition to what we were already doing. The fixed cost is the 40 and the 5. The variable cost now 1,060,000 units, 1,060,000, and that, if you notice there, that's the 11,280,000. The 11,280,000 divided by the $188 per unit right here, the 188 per unit. So we take the increase of this expansion is going to increase our sales by 11,280,000 divided by the 188 right here, the per unit means so 11,280,000 divided by the 1,088,000 plus the additional 1,000 units sold. That's how we get to our right here, this variable cost of 93,280,000. So our operating income then is 61 million. So our fixed costs go up, our variable costs are going to change because of additional units, and then we can do number 7. If the proposal accepted and sales remain the same at the current level, what will operating income or loss be? Well, in this case, our present operating income was 60 million. And if you look in your text, that's right there on the income statement, our operating income of 60 million. And it just said if we did this expansion, it would increase our fixed cost by 5 million. We don't have to worry about variable costs because it just said if sales remain the same, nothing else changes, then what will that do to our operating income? Well, it's going to drop it by another $5 million. That basically concludes our chapter 20 on cost volume profit, CVP. Great chapter. Please take the time to review these exercises again, and having read the chapter so that you understand contribution margin percentage, unit contribution margin, target profit, all of these concepts and how that affects fixed costs, of course, stay the same, how it affects variable costs. A good review of chapter 20.